another episode of In the Divide, where we're sharing all things crypto together with Algorand. So, hopefully, everyone's had a wonderful couple of weeks. I've been gone. I went out doing some work at Consensus 2023. Had a great time there. Had some various things that we did, some interviews that's going to be coming here on YouTube. Met with, got some swag here, some swag here, some swag. Um, this is, I think this thing is this from Algo. Got a couple things from Algorand. Met John Woods. We supposed to have an interview, but some things got twisted and turned. I got not feeling well, but it's going to be still to come. I got some other tasty things for you that's coming up. I want you to go to my Niftgen account. It's going to be in the description. If you want to see Napoleon Dynamite, he was there also. He was giving his take on crypto. He's a pretty down to earth kind of guy, um, but he had some very, I think, very grounded things to say about crypto and his approach to crypto. It's going to be in the link in the description. Go ahead, go over to Niftgen and see that. Some other content is going to be over on Niftgen also. I'm going to be dropping some of the interviews here also on YouTube. Go ahead and support the content. But today, what I want you to know is today I'm going to focus on the banking market, the financial market. Hopefully, if you follow me, you understand kind of my feelings on what's going on with the financial markets. I'm not one to really like the current system of governance with the financial markets because they don't do it right. It's not a great system because the central planners don't know how to plan. It's very reactive and it hurts many of the people that they're trying to help because you just you can't. The central planning is always going to be a step behind. So banks are failing. Signature, Silicon Valley, and now First Republic is trying not to go out of business. Now, I want to show you a video because this actually shows uh, a big way why central plannings have failed. Jerome Powell and Janet Yellen. And this is not just a 2 year problem. This is a problem that they've been had for the last 20 years where they're quantitative easing, they're putting easy money in, and what they did uh, at the beginning of last year and this year, where they raised the debt so fast, they're the one that actually killing the banks because banks move based on trying to make a profit, not a profit where they're killing it. They're making a profit over a span of time, long moves, safe moves, and usually those long safe moves are at a 5 year, 10 year clip. You're doing the things to maximize the money that you have, which is not yours. People have given you money, so if you can make enough money off of giving money, you're making a pure profit. You just don't have to, you just have to not lose it. So what happens is when you give this money to these banks, and then what happens, you start raising the interest rates so quickly, it doesn't give the banks a chance to pivot or change because they already bought their bonds, they already bought into whatever the government, whatever they thought the finance outset was the safest to put their funds in. And then come along the feds, right? And start jacking up interest rates. Now, if you know what money does, money follows money. So, reason why there's a zero interest rate is because you want money to move. Because if it's zero interest rate, then what's the point of putting money in any kind of savings because it's not earning? You might as well invest it in something that's going to earn money, earn your money, more money. It's an investment. So you're making money on your money. You don't keep it in bank, you don't save it. That's one of the reasons why the 0% is you don't want people saving money because you're decentivizing people to save money, to keep money stable or safe. So we start jacking up the rates at the rate they did. What's going to happen is people who understand money and know want their money to work for them understand now that these interest rates are high. I can put my money in a safe interest bearing account. I can buy some of these federal funds here, federal bonds and stuff, and guess what? I can make more profit on that than sitting in another investment, and it's safer because now the interest rates are up. Then you get money start moving where money needs to move into these higher interest bearing accounts. And then slowly and slowly, the run on the bank happens because capital moves where money is going to be working. So I wanted you to check this out because as I was looking, I came across this and
downward plunge, but still down over 17% in the last 2 days as pressure mounts. But our next guest is pointing a finger at two individuals for the lender's downfall. Fed Chair Jerome Powell and Treasury Secretary Janet Yellen. Chris Whalen,
there
Whalen
it fall.
Global Advisors,
The Fed, central policy.
Now, Chris, great to have you here with us this morning.
Good morning.
All right, so what's up? Why is it Jay and Secretary Yellen's fault?
Well, particularly Chairman Powell, but also I think Secretary Yellen, were advocates of a strategy that's called go big at the Fed. After 2018, you recall at the end of the year, we had a big problem in the money markets. And so I think Chairman Powell and some of his colleagues panicked in Washington and they decided to provide more reserves. They did so in 2019. And then we had COVID and they even went bigger and they expanded the Fed's balance sheet almost $9 trillion.
See, all that easy money putting into the market. One of the things people don't understand when you do all these things, you condition people to act a certain way. If you're doing free money, that's the market, the way the money moves, people start moving and making decisions. And all this free money that they're just throwing out there with COVID, all these things, people are making plans based on the current market structure that they're in. And these businesses are making plans. And all of a sudden, when you do a sharp pivot and you do it sharply and fast, then you're going to break something. And this is what they understood. They understand this. But you know, one of the things that's happened is that they understand that the public won't hold the central planners accountable because we don't understand economics. We don't pay attention. We don't focus enough on what's going on. We focus on what they tell us to, and then we'll focus on, well, the banks are wrong. The banks are this, and the rich people are doing bad things, and it's because of the central planners. And this is why we need decentralized finance. This is why we need cryptocurrency.
So what they did in essence was throw a lot of money at a perceived problem, but they've created a real problem now, which is that interest rates have risen. All the paper that was originated in 2020 and 21 is now trading 15, 20 points below the price where it was issued. And the banks are facing huge losses. Also, other investors, bond investors, REITs, all sorts of people that own these high quality AAA rated securities. We're talking about treasuries, Ginnies, Fannies, Freddies, right? Which are supposed to be low risk, but the Fed has created huge market risk. And so these outliers like Silicon Valley, First Republic have tipped over in a
Now, I wanted to say this: people who watch financial news and stuff like Yahoo, CNBC, Bloomberg, and stuff like that. There's a lot of people on here that, especially these news reporters, and they really don't know what they're talking about. They don't ask good questions. They seem like there's an agenda behind a lot of them as far as some of the questions they're asked. It's just kind of like this the first time they've ever been or heard financial news.
Difficult funding market. And even JP, even Bank of America, you can see how their cost of funds is rising very rapidly year over year.
Their cost of funds is rising, Chris. Hey, it's Julie. It's good to see you.
Hey.
Their cost of funds is rising. However, the whole issue of unrealized losses sitting on their balance sheet, like that in and of itself, isn't that much less of an issue if it is, isn't it even almost a moot point at the biggest banks, at everybody besides the banks that seem the most distressed? I mean, those banks don't have to do anything with that stuff, right?
No, you see, that's the issue with in a way, yes, it's an optics problem. So back at the end of the third quarter last year, it was horrible. It was almost $1 trillion in mark-to-market losses on available for sale and also held to maturity securities. But the problem, Julie, is that we originated $25 trillion worth of securities in 20 and 21 of all descriptions. That paper has very low cash flow. So if I'm holding Ginnie Mae 2s and my cost of funds is now 5, I'm losing money. Okay.
So the basics of this is that a lot of times when we see some things in the market, we're focusing on the wrong thing, and it's the opposite of it. And that's why if you do any kind of trading, investing, you've heard of the fear and greed index. A lot of things that move the market are not necessarily logic-based things. It's the fear of something happening. It's it's speculation, and some of the times the speculation, just the thought of something that can happen, will cause a run in a negative direction. And this is one of the things that's risky in investing in stocks, or doing things in such a way where you're not really understanding, because whoever has the most information usually can predict things uh, closest to what they're going to do. And a lot of times it's the big institutions have most information.
Because they have fixed rate mortgages on their books. In this case, the banks can adjust slowly, but they can't adjust in a year. And what the Fed has done is they've raised, T-bill rates up to 5%, and JP Morgan and the other banks have a cost of funds that's still around 1. So they're not competitive, and they are going to have to change their cost of funds to compete with the Treasury and compete with other alternatives. See, the narrative said the big banks would be advantaged in this situation, Julie. That's not the case. All banks are competing now with Uncle Sam. And that's the difficulty, because they can't just sell these bonds and take a 10 or 15-point loss. That's the issue. So look at First Republic. The industry is saying, we're not going to clean up this mess. This is your problem. Okay? That's the little standoff that's going on with First Republic right now.
If First Republic is not saved, is there a banking crisis in sentiment, at least, that continues to prevail?
I think it will seriously impair bank earnings, because let's remember, it's not the Treasury that stands behind the FDIC, it's the banking industry. They paid in 2008, they cleaned up most of the mess, and this time they are already going to have to pay for Silicon Valley and Signature. The sale of the Signature assets is not going to go very well. They're going to be lucky to get 50 cents on the dollar for what's left. So that's going to be a loss to the industry. The industry doesn't want to get stuck with this because they perceive it as the Fed's problem. The Fed did this by doing too much in the bond market. And they've created a horrible problem, because remember, the mortgage securities that they bought in 20 and 21 have now extended their durations of 15 and 20 years. And that's a huge problem for the bond market. So, I think Yellen and Powell both have issues to deal with that they don't really want to explain in Washington, because nobody wants to hear it. But they do have a real problem in the banking industry. You're going to see more bank failures.
So, and that's where I want to just highlight right there. You will see more bank failures because the central planners don't know how to plan. You will see fear in the market because a recession is here and will be here and will get sharper. I'm not saying this because I want to. I'm not saying it, but I'm telling you the reality behind it. Government and the people don't ever want the people to panic. That's their number one thought process. We can't have the people panic. So they lie to you because they don't want you to panic. But lying to you can create a panic, can create a delusion to where we think that we're better than often what we are. And that's where we are. We're in illusion land of thinking that we're better off than what we really are. Monetarily, we are not great. We need to get things decentralized because that's the only way we're going to create more stability for the long term. That's why crypto is needed. That's why decentralized finance is needed. That's why people need to get woken up to about what's really making some of these things worse